There is a lie at the heart of modern finance, a seductive and dangerous myth whispered in the glowing ticker symbols of financial news networks and screamed from the headlines of market-moving websites. The lie is that wealth is forged in the crucible of complexity, that to get rich, you must be a visionary, a futurist, a genius capable of predicting the next paradigm-shifting technology before anyone else. You are told to find the next Amazon in a sea of unknown e-commerce startups, to pick the one biotech firm that will cure a generation's disease, to decipher the cryptic code of the next world-altering algorithm. You are taught that the path to financial freedom is a series of 10-foot hurdles, each requiring a heroic leap of faith, intellect, and luck. And because most of us know, deep down, that we are not superhuman visionaries, we either gamble and lose, or we sit on the sidelines, paralyzed by the perceived complexity of it all, believing that the game of wealth creation is not meant for us. But what if it's all a fabrication? What if the greatest investor of our time, a man who has compounded wealth at a rate that defies financial gravity, built his entire 9-figure-a-day empire on a principle so simple, so profoundly boring, that it's almost insulting? What if the secret to building lasting generational wealth isn't about jumping over 10-foot hurdles, but about finding a 1-foot hurdle you can easily, confidently, and repeatedly step over for the rest of your life? This is the central, immovable secret of Warren Buffett's success. It's a principle that turns the entire financial media complex on its head. He doesn't hunt for unicorns in the tangled forests of Silicon Valley. He doesn't speculate on cryptic white papers or Phase 2 clinical trials. He invests in businesses that are, in his own words, simple and understandable. He looks for boring. He looks for predictable. He actively searches for the 1-foot hurdle, because in the world of long-term investing, it is not the height of your leap that matters, but the certainty of your landing. This is a fundamental transformation in thinking. It's a shift from being a speculator, betting on uncertain futures, to being an owner, buying into predictable presents. It prevents the single most costly mistake an investor can make: venturing outside of what you can understand, where you have no analytical edge, and becoming a gambler disguised as an investor. By the end of our journey today, you will possess a new lens through which to see the entire landscape of the market. You will learn to ignore the siren song of complexity and instead hear the quiet, consistent hum of the cash-generating, predictable, and brilliantly boring businesses that are the true engines of durable wealth. This isn't a stock tip. This is a complete operating system for portfolio growth, risk management, and ultimately, a more peaceful and prosperous path to financial freedom. We are going to deconstruct this 1-foot hurdle principle into its 5 core pillars, building a fortress of logic that will protect your capital and allow it to compound for decades to come. Our first pillar is the bedrock upon which this entire philosophy is built. It is the concept that governs every decision Buffett and his partner Charlie Munger have ever made. It's called the circle of competence. This isn't just a quaint saying. It is a brutal, uncompromising filter. It means you only invest in companies you can thoroughly understand, and you have the intellectual honesty to know where the boundaries of your understanding end. The hurdle is only 1 foot high if the racetrack is one you have walked 1,000 times before. If you're on an alien planet, even a 6-inch rock can trip you and send you tumbling into an abyss. Knowing what you own, and more importantly knowing why you own it, is the first and most critical step in transforming yourself from a market gambler into a business owner. To understand the raw power of this idea, we must travel back to 1972. The world was a different place. The Nifty 50 stocks were the darlings of Wall Street. Companies like Xerox, IBM, and Polaroid. They were the tech titans of their day, companies with seemingly unstoppable growth that you were supposed to buy at any price and never sell. Investing in these companies was seen as sophisticated. It was complex. It was the smart money play. But in Omaha, Nebraska, Warren Buffett and Charlie Munger were about to make a decision that seemed, by comparison, almost comically simplistic. They were looking at a candy company. Not a technology company, not a pharmaceutical giant, but a family-owned business based in California that made chocolates and brittles, See's Candies. The story of the See's Candies acquisition is the foundational anecdote for the circle of competence. See's was put up for sale by the C family, and a man named Bob Flaherty at Blue Chip Stamps, a company Buffett controlled, brought him the deal. The asking price was $30 million. The company was earning about $2 million after tax, so they were asking for a multiple of 15 times earnings. By the standards of the cigar butt investing Buffett had practiced for years, buying terrible companies at dirt cheap prices, this was expensive. But when Buffett and Munger looked at See's, they didn't just see numbers on a page. They saw a business they could understand in its entirety in less than 5 minutes. What does See's do? It makes high-quality candy. How does it make money? It sells that candy for more than it costs to make. Who are its customers? Loyal, often multi-generational patrons who associate the See's brand with holidays, celebrations, and quality. What are its competitive advantages? A powerful, trusted brand built over decades, a fanatical customer base, and a premium product that commanded pricing power. There was no complex technology to evaluate, no patent cliff to worry about, no disruptive competitor from a garage in Palo Alto that could render their entire business model obsolete overnight. It was a one-foot hurdle. Munger, in particular, pushed Buffett to see the value beyond the simple numbers. He convinced him that it was better to buy a wonderful company at a fair price than a fair company at a wonderful price. They flew out to meet with the C family. They toured the facilities. They likely tasted the candy. They understood the simple, repeatable magic of the business. It had a durable competitive advantage, a brand moat that was almost impossible for a competitor to replicate. A customer wasn't just buying chocolate. They were buying nostalgia, trust, and the feeling of giving a special gift. You couldn't engineer that feeling in a lab. After some negotiation, they settled on a price of $25 million. At the time, See's had about $8 million in tangible assets, things like factories and inventory. This meant they were paying a $17 million premium for the intangibles, the brand, the customer loyalty, the goodwill. This was a major evolution in Buffett's thinking, and it was only possible because he was operating deep within his circle of competence. He could confidently value those intangibles because he understood the business so intimately. He knew with a high degree of certainty that customers would still be lining up for See's candies 5, 10, and 20 years down the road. The result? See's Candies has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, and it did so without requiring significant additional capital investment. It became a cash gusher that funded other acquisitions. It taught Buffett one of the most important lessons of his career: the immense value of a simple, predictable business with a strong brand. Contrast this with the Nifty 50. Many of those one-decision stocks, the complex giants of the 1970s, were decimated in the bear market of 1973-74. Polaroid, a technological marvel, eventually went bankrupt. Investors who bought into the story without fully understanding the competitive dynamics and the relentless pace of technological change were wiped out. They were trying to jump over a 10-foot hurdle in the dark. Buffett, meanwhile, was happily stepping over his 1-foot hurdle, collecting billions of dollars in cash from selling chocolates. The psychological principle underpinning the circle of competence is a powerful defense against two of the most destructive cognitive biases in investing: the overconfidence bias and its close relative, the Dunning-Kruger effect. The overconfidence bias is our natural tendency to overestimate our own knowledge and abilities. In investing, this manifests as a belief that we can predict the future of a complex industry based on a few articles we've read or a segment we saw on television. We hear about advancements in artificial intelligence, and we suddenly believe we have an edge in picking the winning AI stock, despite having no background in machine learning, semiconductor design, or enterprise software sales cycles. The Dunning-Kruger effect is even more insidious. It's a cognitive bias whereby people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. This is rampant in the stock market. A novice investor, buoyed by a bull market where everything is going up, makes a few lucky bets on tech stocks. They mistake luck for skill. Their brain floods with dopamine, reinforcing their genius. They then feel qualified to make even bigger bets on even more complex companies. perhaps a clinical-stage biotech firm whose success hinges on the molecular interaction of a protein they can't even pronounce. They have climbed to the top of Mount Stupid, as the Dunning-Kruger graph famously illustrates, blissfully unaware of the vast chasm of knowledge that lies beneath them. Buffett's circle of competence is the ultimate antidote to this cerebral poison. It is an act of profound intellectual humility. It's the admission that I don't know, and I don't have to know. He doesn't try to predict the future of aerospace engineering or the winner of the streaming wars. He stays in his lane. Why? Because when you are operating within your circle, your analysis is grounded in reality, not speculation. You can evaluate management's decisions, understand the key performance indicators, and recognize when the competitive landscape is changing. When you step outside that circle, you are no longer investing, you are gambling. You are relying on the story, the hype, the hope that someone smarter than you has it all figured out. This is the path to ruin. By strictly defining the boundary between what you know and what you don't, you protect yourself from your own worst enemy. The overconfident brain that thinks it's a genius when it's really just lucky. It forces you to substitute ego-driven speculation with a quiet, confident, and fact-based approach to wealth management. So how do you, as a retail investor or an entrepreneur looking to make smart capital allocation decisions, apply this? We need to translate the theory into a practical mental model. Let's call it the explain it to a child test. This is your blueprint for defining your own circle of competence. Before you ever consider investing a single dollar into a company, you must be able to pass this test. Here is the step-by-step process. First, grab a piece of paper or open a blank document. At the top, write the name of the company you're considering. Now, set a timer for 5 minutes. Your task is to explain, in simple terms that a reasonably intelligent 12-year-old could understand, exactly how this business works. Step 1 of the test, the business model. In 1 or 2 sentences, describe what the company sells and to whom. For example, for Coca-Cola, they sell concentrated syrup to bottling partners around the world, who add carbonated water, bottle it, and sell the drinks to stores and restaurants. For a company like Palantir Technologies, this becomes much harder. They sell complex data analytics software platforms to government agencies and large corporations to help them integrate and understand vast amounts of information. The vagueness and jargon should be your first red flag. If you can't state it simply, you don't understand it deeply. Step 2, the revenue streams. How does the company get paid? Be specific. For See's Candies, they get paid when a customer walks into one of their stores or goes on their website and buys a box of chocolates. Simple. For a modern software-as-a-service company, it might be, they charge a monthly subscription fee per user, with different tiers for different levels of service. That's still understandable. But for a complex biotech firm, the answer is, they don't make any money right now. They are burning cash in research and development, and they hope to get paid in 8 years if their new drug passes 3 phases of FDA trials, and they can successfully license it to a major pharmaceutical company. This is not a revenue stream, it's a prayer. Step 3, the competitive advantage. Why do customers choose this company over its competitors? What stops another company from coming along tomorrow and doing the exact same thing, but cheaper? For a railroad like BNSF, they own the tracks. It would be practically impossible and astronomically expensive for a competitor to build a competing rail line right next to theirs. That's a powerful, understandable advantage. For a hot new social media app, it has a lot of users right now, the network effect. That's a valid advantage, but you must then ask how durable it is. Can users switch easily? Is another app gaining traction with a younger demographic? The questions quickly become more speculative and less certain. If, at the end of these 5 minutes, your explanation is a jumble of industry jargon, acronyms, and vague hopes about future technology, you have failed the test. The company is outside your circle of competence. It doesn't matter if a famous analyst on TV loves the stock. It doesn't matter if it's in a hot sector. You must have the discipline to say pass and move on. The goal of this exercise is not to be a genius. The goal is to be honest. Building your list of companies that reside inside your circle, be it retail, banking, insurance, food production, or whatever your personal or professional experience lends you an edge in, is the first, most crucial step in this entire process. This disciplined approach to stock picking is the foundation of long-term investing success. Now, to truly appreciate the wisdom of this path, we must dedicate some time to exploring its opposite, the path of the 99%. This is the antithesis, the road paved with complexity, hype, and ultimately financial devastation. Let's journey back to the late 1990s, to the height of the dot-com bubble. This was a period when the circle of competence was not just ignored, it was actively mocked. Old economy metrics like earnings and cash flow were deemed irrelevant. The new paradigm was about eyeballs, mind share, and getting big fast. Picture the average retail investor of 1999. Let's call him Frank. Frank is a dentist. He's smart, successful in his own field, and has saved up a decent nest egg for retirement. His circle of competence includes dentistry, perhaps local real estate, and the small business management skills he's learned running his practice. But every day, he turns on the news and hears stories of 20-somethings becoming billionaires overnight by starting internet companies. His brother-in-law just made a fortune on a company called Qualcomm. He feels a powerful psychological force welling up inside him, FOMO, the fear of missing out. So Frank opens an E-Trade account. He's looking for the next big thing. He stumbles upon a company with a catchy name and a clever Super Bowl ad, Pets.com. What does Pets.com do? It sells pet supplies online. This seems simple enough, superficially passing the first part of our test, but Frank doesn't dig any deeper. He doesn't ask about the competitive advantage or the revenue model. He just knows that pets are a huge market, and the internet is the future. It's a story stock. He buys a large block of shares. He has officially stepped outside his circle of competence. He doesn't understand logistics, customer acquisition costs, or the razor-thin margins of retail. He doesn't realize that the company is spending millions on advertising to acquire customers who spend, on average, far less than they cost to acquire. He has no idea that their business model involves shipping heavy bags of dog food at a loss. He just sees the stock price going up. He feels like a genius. He has fallen victim to the Dunning-Kruger effect, his initial success blinding him to his own ignorance. Meanwhile, in Omaha, Warren Buffett is being ridiculed. He's called a dinosaur, a relic who doesn't get the new economy. He publicly states that he won't invest in these dot-com companies because he can't project their cash flows 10 or 20 years out. They are outside his circle of competence. He says, if I don't understand it, I don't get into it. He is disciplined. He is patient. He is, in the eyes of the frenzied market, a fool. Then, in March of 2000, the bubble bursts. The Nasdaq, filled with companies like Pets.com, begins a catastrophic collapse that will ultimately wipe out nearly 80% of its value. Pets.com itself goes from its IPO to liquidation in just 268 days. Frank the dentist, who bought into the hype, sees his investment evaporate. It goes to zero. He and millions like him learn a brutal lesson. When you invest in what you don't understand, you are at the mercy of the storytellers. And when the story changes, you are left holding a worthless bag. Buffett, on the other hand, with his portfolio of boring companies like insurance, furniture retail, and soft drinks, not only preserves his capital, but has a massive war chest of cash ready to deploy when the panic creates incredible bargains. This is the stark difference between a strategy built on competence and one built on hope. The direct financial connection between staying within your circle of competence and building wealth is not abstract. It is mathematical and can be seen directly in how a professional analyst values a business. The gold standard for determining the intrinsic value of a company is a discounted cash flow, DCF analysis. The concept is simple. A business is worth the sum of all the cash it will generate from now until Judgment Day, discounted back to its present value. The key and most difficult part of this equation is forecasting those future cash flows. Now, imagine you are trying to do a DCF analysis for two companies. Company A is Hershey's, the chocolate company. It's a simple, predictable business. You can look at its financial history, see its steady growth, its stable margins, and its brand strength. You can, with a reasonably high degree of confidence, project its cash flows for the next 10 years. You can assume people will still be eating Hershey's Kisses and Reese's peanut butter cups. Your forecast won't be perfect, but it will be within a rational range. Company B is a hot new software company that uses artificial intelligence to optimize supply chains. It has only been public for 2 years, has never turned a profit, and is in a hyper-competitive industry with giants like Oracle and SAP, plus hundreds of other startups. How do you forecast its cash flows for the next 10 years? What will its margins be? Will its technology even be relevant in 5 years? Will a competitor develop a better algorithm? Your forecast is not a projection. It's a wild guess. The range of possible outcomes is enormous, from bankruptcy to world domination. This uncertainty directly impacts the valuation. In a DCF model, you use a discount rate to bring future cash flows back to the present. This rate reflects the riskiness of the investment. For a stable, predictable company like Hershey's, you might use a low discount rate, say 7 to 8%. For the speculative AI company, the uncertainty is so high that you'd have to use a much higher discount rate, perhaps 15% or 20%, to compensate for the risk. A higher discount rate drastically reduces the calculated present value of the company. By staying within your circle of competence, you are naturally drawn to businesses like Hershey's, where your forecasts are more reliable. This allows you to make investment decisions with a greater degree of confidence. You can calculate an intrinsic value that is grounded in reality, not fantasy. This is the core of value investing. It allows you to wait patiently until the market price of that predictable business falls significantly below your calculated intrinsic value, creating a margin of safety. You simply cannot do this with a company you don't understand. Investing outside your circle forces you to abandon valuation based on predictable cash flow, and instead base your decision on narrative, hype, and the hope that the stock price will go up simply because others will buy it from you at a higher price later. That is not a financial strategy, it is the greater fool theory, and it almost always ends in tears. The circle of competence is your fortress wall, protecting you from the wild guesses and ensuring your financial decisions are built on the solid ground of knowable facts. Now we move to our second pillar, which builds directly upon the first. It's not enough for a business to be simple and understandable. A simple lemonade stand is easy to understand, but it's a terrible investment if anyone can set up a competing stand right next to yours. The second pillar is the moat, seeking predictable dominance, not fleeting innovation. A 1-foot hurdle is only a sustainable advantage if no one can come along and build a 10-foot wall in front of it tomorrow. Buffett realized that the most valuable businesses in the world are not just simple, but they are also protected by a deep, wide, and sustainable competitive advantage, a moat, that keeps competitors at bay and allows the company to earn high returns on capital for decades. The quintessential story of Buffett's focus on moats is his landmark investment in the Coca-Cola Company in 1988. On the surface, it's the definition of a simple business. They make a sugary brown liquid. But beneath that simplicity lies one of the most powerful moats ever constructed in business history. To appreciate Buffett's genius, we have to understand the context of the time. The late 1980s were a period of great fear and uncertainty in the market. The Black Monday crash of October 1987 had terrified investors, and many were still licking their wounds. Furthermore, Coca-Cola itself had recently suffered a massive, self-inflicted public relations disaster with the launch of New Coke in 1985, a move that alienated its most loyal customers and was seen as a colossal blunder. While many investors saw a company that had stumbled, Buffett saw an opportunity to buy a slice of the greatest business on earth at a reasonable price. He began accumulating a massive position in Coca-Cola, ultimately investing over $1 billion, which at the time represented more than a quarter of Berkshire Hathaway's entire portfolio value. It was an incredibly concentrated bet. He wasn't just buying a stock, he was buying a business, and he was doing so because he understood the impregnable nature of its moat. What was that moat? It wasn't the secret formula, which competitors had been trying to imitate for a century with little success. The real moat was a combination of two things. First, the brand. The Coca-Cola brand was, and is, a global icon. It is seared into the collective consciousness of billions of people. As Buffett famously said, if you were given tens of billions of dollars and told to unseat Coke as the world's leading soft drink, you couldn't do it. The brand represents something more than a beverage. It represents happiness, refreshment, and American culture. This creates what Buffett calls share of mind. When someone anywhere in the world thinks of having a refreshing drink, the word Coke pops into their head. This mental real estate is priceless and virtually impossible for a competitor to capture. Second, its global distribution network. Coca-Cola had spent a century building an unparalleled system of bottlers and distributors that could get its product within arm's reach of desire in over 200 countries. Whether you were in a bustling New York City deli or a dusty village in rural India, you could find a cold Coke. This logistical masterpiece created massive economies of scale and acted as a huge barrier to entry for any potential competitor. Buffett recognized that the new Coke fiasco, far from weakening the company, had actually demonstrated the incredible power of its brand. The public outcry and demand for the return of Coke Classic was a free multi-million-dollar marketing campaign that proved how deeply people cared about the product. He saw past the short-term noise and focused on the long-term, durable reality of the business. The business was simple, the moat was wide, and because of the recent market crash and the memory of the marketing blunder, the price was fair. This simple insight, this focus on a predictable, dominant business, made over $10 billion for Berkshire shareholders. It is a masterclass in investing in the moat, not the moment. The psychological principle at play here is a battle against the availability heuristic and recency bias. Our brains are wired to give more weight to information that is recent, vivid, and easily recalled. The financial media feeds this bias relentlessly. We are bombarded with stories of the latest technological breakthroughs, the hottest IPOs, and the disruptive startups that are changing the world. These stories are exciting and readily available in our minds. As a result, we tend to overestimate their importance and their long-term viability. We see a company with a hot new product and, influenced by the availability heuristic, assume it will dominate its industry for years to come. Simultaneously, recency bias makes us believe that recent trends will continue indefinitely. If a stock has been going up, we expect it to keep going up. If an industry is facing short-term headwinds, like Coca-Cola after the 1987 crash, we project that pain into the future and become overly pessimistic. Buffett's approach is a conscious and deliberate rejection of these mental shortcuts. He actively ignores the noise of the new and the recent. Instead, he focuses his attention on the boring, enduring qualities that create a moat. A brand that has been built over 100 years is far more predictable than a technology that was invented 18 months ago. A distribution network that is physically embedded in 200 countries is a more durable advantage than a temporary lead in software features. By focusing on the strength of the moat, he bypasses the brain's tendency to get seduced by the new and shiny. He replaces the fleeting excitement of innovation with the quiet confidence of enduring dominance. This is a critical component of risk management and is essential for any long-term investing strategy. To apply this principle, you need a practical mental model for identifying and evaluating business moats. Let's create the moat identification checklist. When you analyze a company, especially a simple one within your circle of competence, you should systematically evaluate it against these 5 sources of durable competitive advantage. First on the checklist, brand power. Does the company's brand name alone allow it to charge more for a product that is functionally similar to its competitors? Think of Tiffany & Company jewelry, an Apple iPhone, or a bottle of Heinz ketchup. Consumers are willing to pay a premium not just for the product, but for the trust, consistency, and status associated with the brand. A strong brand is a powerful moat because it lives in the customer's mind. Second, switching costs. Is it difficult, expensive, or time-consuming for customers to switch from this company's product or service to a competitor's? Consider your bank. Moving all your automated payments and direct deposits is a huge hassle, creating a sticky relationship. Or think of enterprise software from a company like Microsoft. An entire corporation trains its employees and builds its workflows around Microsoft Office. The cost and disruption of switching to a new system would be immense, even if a competitor offered a slightly better product. Third, network effects. Does the product or service become more valuable as more people use it? This is the classic moat for companies like Visa and MasterCard. The more merchants that accept Visa, the more valuable it is for consumers to have a Visa card. And the more consumers who have a Visa card, the more essential it is for merchants to accept it. This creates a powerful, self-reinforcing feedback loop that is incredibly difficult for a new entrant to break into. Fourth, cost advantages. Can this company produce its product or service significantly cheaper than its rivals, allowing it to either have higher margins or win on price? This can come from economies of scale, like Walmart's massive purchasing power and logistical efficiency, or from a unique process or geographical advantage, like Geico's direct-to-consumer insurance model, which bypassed the expensive agent network. Fifth, regulatory protection or unique assets. Does the company benefit from patents, government licenses, or control of a unique, hard-to-replicate asset? A pharmaceutical company with a patent on a blockbuster drug has a legal monopoly for a period of time. A ratings agency like Moody's has a regulatory moat as its ratings are embedded in the financial system. And a railroad like BNSF has a unique asset moat in its thousands of miles of irreplaceable track. By using this checklist, you move from a vague sense that a company is good to a precise understanding of why it is good. You can articulate the source of its strength, and more importantly, you can begin to ask the critical question, is this moat getting wider or narrower over time? A simple business with a widening moat is the holy grail of value investing. Now let's examine the antithesis, the siren song that lures so many investors onto the rocks, the disruptor trap. This is the story of a company that seems simple and innovative, but lacks a durable moat. The meal kit delivery service Blue Apron is a perfect case study. In the mid-2010s, Blue Apron was a Wall Street darling. The business model was incredibly easy to understand. They send a box of pre-portioned ingredients and a recipe card to your door, making it easy to cook a gourmet meal at home. It seemed brilliant. It was a simple business, right in the wheelhouse of our one-foot hurdle rule. Investors poured money into the company, and it went public in 2017 with a valuation of nearly $2 billion. They were sold on the story of disrupting the massive grocery and restaurant industries. But the investors who bought into the hype failed to apply the moat identification checklist. Let's run Blue Apron through it. Brand power? Minimal. There was little to distinguish Blue Apron's box from a dozen other competitors like HelloFresh and Plated. Switching costs? Zero. A customer could cancel their Blue Apron subscription with one click and sign up for a competitor in 5 minutes. There was no loyalty. Network effects? None. The service didn't get better as more people used it. Cost advantages? Quite the opposite. The logistics of packing and shipping individual, perishable boxes were incredibly expensive, and they had to spend a fortune on marketing to constantly replace customers who were churning out. Regulatory protection? Of course not. Blue Apron had a simple business idea, but it had no moat. It was a business in a leaky bucket. As soon as the concept was proven, dozens of competitors flooded the market, from other startups to giant grocery chains like Kroger, who could leverage their existing supply chains. The competition drove customer acquisition costs through the roof and forced prices down. The company's financials crumbled. The stock price, which debuted at $10 per share, collapsed, Today, it trades for a tiny fraction of its IPO price after multiple reverse splits to avoid being delisted. Investors who were seduced by the simple, innovative story but ignored the lack of a protective moat were decimated. This is a crucial lesson. Simplicity is a necessary condition, but it is not a sufficient one. A 1-foot hurdle is only a good bet if you're the only one allowed on the track. The direct financial connection between a strong moat and investment returns is crystal clear when you look at a company's financial statements. A moat manifests itself in two critical ways: pricing power and high returns on invested capital, ROIC. Pricing power is a company's ability to raise its prices over time without losing a significant number of customers. Look at a company like See's Candies. Over the decades, Buffett has been able to consistently raise the price per pound of chocolate, and customers happily pay it because of the brand's association with quality and tradition. This flows directly to the top line as increased revenue and to the bottom line as higher profit margins. A company without a moat, like a commodity airline, is in a constant price war. If they raise prices by $5, their customers will flock to a competitor. They have no pricing power. Even more important is return on invested capital. ROIC is a measure of how effectively a company is using its capital to generate profits. You calculate it by taking the company's net operating profit after taxes and dividing it by its invested capital, which is essentially the debt and equity used to fund its operations. A company with a strong moat, like Coca-Cola or Moody's, will consistently generate a high ROIC, often well over 15% or 20%. This means that for every dollar they reinvest back into their business, they are creating 20 cents or more of annual profit. A company in a brutally competitive industry with no moat, like an average retailer, might struggle to earn an ROIC higher than its cost of capital. This is the engine of compounding. A business that can reinvest its earnings at a high rate of return will see its intrinsic value grow exponentially over time. It's like planting a tree that not only produces fruit but also spawns new, equally fruitful trees every year. For the long-term investor focused on portfolio growth, seeking out businesses with a demonstrably high and stable ROIC, the financial signature of a strong moat, is one of the most reliable paths to beating the S&P 500 and achieving true financial freedom. This brings us to the third pillar, which refines our search for the ideal 1-foot hurdle. We've established that the business must be simple and protected by a moat, but there's another crucial characteristic that Buffett seeks. It must be a business that gushes cash without constantly needing that cash for reinvention. This is the pillar of the toll booth business, valuing predictable cash flow over speculative growth. A true 1-foot hurdle is a business that, once established, doesn't require massive ongoing capital expenditures and research and development just to stay in the game. It sits astride a commercial stream and simply collects the cash as it flows by. The perfect anecdote to illustrate this principle is Buffett's massive acquisition of the Burlington Northern Santa Fe (BNSF) Railway in 2009. On the face of it, a railroad seems like the opposite of a cash-light business. It's incredibly capital-intensive. You have to buy locomotives, maintain thousands of miles of track, and manage huge physical assets. It is the epitome of a boring, old economy business. And Buffett made his bet at a terrifying time. The acquisition was announced in the shadow of the 2008 financial crisis. The American economy was in a deep recession and fear was rampant. So why did Buffett make this $34 billion all-in wager on the economic future of the United States, as he called it? Because he saw BNSF not as a collection of steel and locomotives, but as a permanent, indispensable economic toll booth. A railroad is a vital artery of the economy. It moves the grain, coal, chemicals, and consumer goods that are the lifeblood of the nation. And once the massive upfront investment in the tracks is made, a railroad enjoys a powerful moat. It is virtually impossible for a competitor to get the rights of way and spend the hundreds of billions of dollars required to build a competing line. BNSF and its main competitor, Union Pacific, form a duopoly in the American West. Buffett understood that as long as the American economy grew over the long term, the volume of goods moving on BNSF's tracks would also grow. The railroad has pricing power. It can charge a little more each year to move that freight, and its customers have few other options for moving heavy goods over long distances efficiently. Unlike a technology company, a railroad doesn't have to worry about its core product becoming obsolete. The laws of physics and economics that make rail transport efficient are not going to be disrupted by a kid in a garage. It requires steady capital to maintain the network, yes, but it doesn't require billions in speculative R&D hoping for a breakthrough. It is a business that, once in place, generates a massive and predictable stream of cash. It is the ultimate toll booth. Buffett was buying a slice of America's future economic output, a business whose success was tied to the inevitable, long-term growth of the country itself. He was buying a one-foot hurdle that would pay him and Berkshire's shareholders for a century to come. The psychological trap that the toll booth mindset helps you avoid is what we can call the endowment effect and the sunk cost fallacy, particularly as they apply to research and development. The endowment effect is our tendency to overvalue something simply because we own it. For investors, this means we fall in love with the stocks we've bought, especially if they are built around an exciting story of future innovation. The sunk cost fallacy is the tendency to continue an endeavor once an investment in money, effort, or time has been made. Now consider the world of speculative tech or biotech. A company raises hundreds of millions of dollars to develop a new drug or a new piece of software. It spends years and vast sums of money on the project. Along the way, the data might suggest the project is unlikely to succeed. But the managers and the investors who have bought into the story are trapped. They've already spent so much money, the sunk cost, and they are so emotionally invested in the project, the endowment effect, that they can't bring themselves to pull the plug. They throw good money after bad, hoping for a miracle breakthrough. They are on an endless treadmill of speculative investment, where the next huge capital expenditure is always just around the corner, and the promised payoff is always 5 years in the future. Buffett's focus on toll booth businesses completely sidesteps this psychological minefield. He is not interested in businesses that need to constantly reinvent themselves. A railroad, a candy company, or an insurance company has already won. Its business model is established. Its primary job is not to innovate, but to execute and optimize. The cash it generates is not immediately consumed by a desperate race for the next discovery. Instead, that cash can be returned to the owners, the shareholders, in the form of dividends and buybacks, or used to acquire other toll booth businesses. By focusing on businesses that are already over the finish line, he avoids the emotional and financial drain of betting on the race itself. He doesn't bet on the horse, he owns the racetrack. This is a core tenet of effective risk management. So how can we as investors apply this? We need a mental model to measure the true cash-generating power of a business, and for that, we turn to Buffett's own preferred metric, owner earnings. This concept, which he laid out in his 1986 letter to shareholders, is a more honest way of looking at a company's profitability than the standard net income figure reported on financial statements. Net income can be easily manipulated by accounting conventions. Owner earnings gets closer to the real cash a business owner could take out of the business at the end of the year. Here is a step-by-step guide to calculating a simplified version of owner earnings. First, you start with the company's reported net income. Second, you add back any non-cash charges, with the most common ones being depreciation and amortization. These are accounting expenses, not actual cash expenditures. Third, and this is the crucial step, you must subtract the average annual amount of capital expenditures, the money the company has to spend on things like new factories and equipment, just to maintain its current competitive position and unit volume. Buffett calls this maintenance capex. Let's illustrate with an example. A company reports net income of $100 million. It has depreciation charges of $20 million. Its total capital expenditures for the year were $30 million. The simple free cash flow calculation you often see online would be $100 million plus $20 million. $30 million equals $90 million. But Buffett would ask the critical question, how much of that $30 million in capex was for growth, and how much was just to stay in the same place? If the company had to spend, on average, $25 million a year just to maintain its existing plants and equipment, then the true owner earnings are closer to $100 million net income plus $20 million depreciation, $25 million maintenance capex equals $95 million. The remaining $5 million of capex was for growth projects. The key is to distinguish between a business that has to spend heavily just to tread water and a toll booth business where maintenance capex is low and most of the earnings are truly free to be distributed to owners. A railroad has high maintenance capex, but it is extremely predictable. A speculative tech company might have low maintenance capex but astronomical R&D spending, which is functionally equivalent to capex but far less certain to generate a return. By learning to think in terms of owner earnings, you begin to see companies through Buffett's eyes. You start to value the boring, predictable cash gushers over the exciting but cash-incinerating story stocks. This financial education is vital for any serious retail investor. The antithesis of the toll booth business is the cash-burning biotech venture. This is where the hopes of investors go to die. Imagine a small company. Let's call it CureQuest Labs. It has a promising molecule that, in early trials, seems to have an effect on a rare form of cancer. The story is incredible. If this drug works, it will save lives and make investors billions. It's a story of hope, of world-changing innovation. An investor, let's call her Susan, buys into this story. She invests a significant portion of her savings. She doesn't realize she hasn't bought a business. CureQuest has no sales, no profits, and no cash flow. It is not a business. It is a research project funded by shareholder capital. For years, the company burns through cash. It issues more stock to raise more money, diluting Susan's ownership stake. It hires scientists, conducts trials, and publishes promising but inconclusive papers. The stock price gyrates wildly based on rumors and press releases. Susan is on an emotional roller coaster. Then comes the big day. The results of the pivotal Phase 3 clinical trial are announced. The drug failed to meet its primary endpoint. It was not significantly better than a placebo. The stock, which had been trading on hope, collapses. It falls 90% in a single day. Susan's investment is wiped out. She didn't invest in a toll booth. She bought a lottery ticket. A lottery ticket with extremely long odds that was paid for with her own capital. This happens every single day in the stock market. Speculating on these ventures is the polar opposite of Buffett's approach. He is looking for the sure thing, the business that is already collecting tolls. The biotech speculator is funding the construction of a hypothetical bridge to a land of riches that, more often than not, turns out to be a mirage. The direct financial connection here is one of the most important metrics for value investors: free cash flow, FCF yield. This metric quantifies the toll booth nature of a business. To calculate it, you take the company's free cash flow per share and divide it by the current stock price. The result is a percentage that tells you how much cash the business is generating relative to its market valuation. It's like the yield on a bond. It shows you your cash return as an owner. A mature, toll booth business like a consumer staples company or a utility might consistently trade at a free cash flow yield of 5 to 8%. This means that for every $100 you have invested in the stock, the underlying business is generating $5 to $8 in cold, hard cash each year. That cash can then be used to pay you a dividend, buy back stock, which increases your ownership percentage, or be reinvested to grow the business. A high and stable FCF yield is the financial signature of a healthy, disciplined, and shareholder-friendly company. Now compare that to a cash-burning speculative company. its free cash flow is negative, its FCF yield is negative. For every $100 you have invested, the business is incinerating several dollars a year. The only way your investment can pay off is if the story comes true and the company eventually transforms into a cash-generating enterprise, and then the stock price rises dramatically. You are relying entirely on capital appreciation driven by future hope. A strategy built around accumulating businesses with high FCF yields is a strategy for building real wealth and generating passive income. It is the cornerstone of a portfolio designed for financial freedom, not a portfolio designed for a trip to the casino. This leads logically to our fourth pillar, which is about the source of a business's predictability. If we want simple, moat-protected toll booths, where are the best places to look? Buffett's answer is profound in its simplicity. He focuses on the inevitables, betting on timeless human needs, not fleeting trends. The most predictable one-foot hurdles are businesses that cater to fundamental, unchanging human desires. People will always need to eat and drink. They will always need a roof over their heads. They will always seek protection against unforeseen calamities. They will always want to feel good about themselves. Businesses that serve these deep-seated needs are far more predictable than those built on the shifting sands of technological trends. For a classic anecdote on this, we look not at a multi-billion-dollar public company, but at one of Buffett's smaller private acquisitions that reveals the core of his thinking, the purchase of Nebraska Furniture Mart in 1983. This was not a sexy business. It sold carpets, sofas, and dining room sets. But Buffett was fascinated by its founder, a tiny, indomitable Russian immigrant named Rose Blumkin, better known as Mrs. B. She had started the business in 1937 with a $500 loan and built it into the largest home furnishing store in North America through a simple, relentless philosophy: sell cheap and tell the truth. Buffett observed the business for years. He saw a company that was catering to a fundamental human need, the desire to create a comfortable and pleasant home. This need was not going to be disrupted by technology. People would always need a place to sit, to sleep, to eat. Furthermore, he saw in Mrs. B a manager who was fanatically focused on the customer and on efficiency. The store's massive volume allowed it to buy goods cheaper than anyone else and pass those savings on, creating a powerful cost-advantage moat. The acquisition itself was pure Buffett. He went to meet the 89-year-old Mrs. B. He asked her how much she wanted for the business. She gave him a number. He said, "Done." The deal was sealed with a handshake on a single-page contract without any outside audit of the books. Why? Because Buffett was investing in something he understood completely. He understood the simple, inevitable nature of the furniture business, and he understood the character and track record of its owner. He said he would rather have a business run by the Blumkin family than have an audit from the world's biggest accounting firm. He bought Nebraska Furniture Mart because it was a one-foot hurdle built on the solid ground of a timeless human need. Today, it is part of Berkshire's massive and highly profitable retail division, a testament to the power of betting on the inevitable. The psychological demon that this principle slays is perhaps the most powerful and destructive force in modern markets: FOMO, the fear of missing out. FOMO is a primal, social emotion. We are wired to feel anxiety when we see members of our tribe succeeding at something and we are not participating. In financial markets, this is weaponized against the retail investor. You see a headline about a meme stock soaring 1,000%. You see your neighbor bragging about his cryptocurrency gains. Your brain's alarm bells go off. You feel like you are being left behind. This feeling triggers an impulsive, emotional reaction. You abandon your disciplined strategy and pile into the hot trend, often at the very peak of its mania. Buffett's focus on the inevitables is the ultimate shield against FOMO. When you see the world through his lens, the latest fads and manias become background noise. You aren't tempted to chase the hot cannabis stock because you ask yourself, is this business catering to a timeless human need with a durable competitive advantage? Or is it a speculative commodity business in a crowded field? You aren't tempted to go all in on a niche cryptocurrency because you ask, Is this a productive asset that generates cash flow, or is it a digital speculation whose value depends entirely on someone else being willing to pay more for it later? By anchoring your investment philosophy in the bedrock of basic human needs, you become immune to the madness of crowds. You can calmly watch the waves of speculation crash and recede, knowing that your portfolio is filled with companies that will still be profitably selling soap, soda, and insurance long after the current mania is a forgotten footnote in financial history. The applied mental model for this pillar is the decade-forward test. It is a simple but powerful thought experiment you should conduct for any potential long-term investment. The process is straightforward. Look at the company's core product or service and ask yourself, in 10 years, and then in 20 years, is it a virtual certainty that people will still be using this product in a largely similar way, and will the demand be as strong or stronger? Let's apply the test. Company 1 is Wrigley's, the chewing gum company, now part of Mars but a longtime Buffett holding. Will people be chewing gum in 20 years? Almost certainly. It's a simple, cheap pleasure that has been around for centuries. The product will likely be identical. Wrigley's passes the test with flying colors. Company 2 is Heinz, the ketchup company. Will people be putting ketchup on their fries in 20 years? Absolutely. The brand is dominant, the product is timeless, it passes. Company 3 is Geico, the insurance company. Will people need to insure their cars in 20 years? Yes. The need for financial protection against accidents is permanent. It passes. Now let's try a few others. Company 4 is a leading smartphone manufacturer. Will people be using smartphones in 20 years? Probably, but what will they look like? Will this specific company still be dominant? Or will a new competitor have leapfrogged them with a new technology, like augmented reality glasses? The path is far less certain. The hurdle is higher. Company 5 is a popular social media app. Will it still be the dominant platform in 10 years? History tells us probably not. Think of MySpace or Vine. The landscape of consumer tech trends is a graveyard of former kings. The test reveals that the future here is highly speculative. The decade-forward test is a filter. It helps you separate the truly durable businesses from those that are merely fashionable. It forces you to think like a long-term business owner, not a short-term stock trader. For entrepreneurs, this test is equally valuable when deciding which business ventures to pursue. Building a business around a timeless need gives you a tailwind that the trend chaser can only dream of. The antithesis is the trend chaser's portfolio. This is the tragic story of an investor who is constantly whipsawed by FOMO, jumping from one hot narrative to the next. Let's follow this investor's journey. In 2018, cannabis stocks are all the rage as legalization spreads. He pours money into several Canadian producers, ignoring their lack of profits and intense competition. A year later, the bubble bursts, and he loses 80% of his investment. In 2020, during the pandemic lockdown, at-home fitness is the new theme. He sells his cannabis stocks at a loss and buys Peloton at its peak, convinced that gyms are dead forever. A year later, the world reopens, Peloton's growth stalls, and the stock collapses. He sells in a panic. In 2021, NFTs and the metaverse are the hot new things. He takes what's left of his capital and buys digital art and speculative metaverse stocks. We all know how that story ended. This investor's portfolio is a whirlwind of activity, high commissions, and terrible timing. He is always buying at the peak of the hype and selling at the trough of disillusionment. His fatal flaw is that he is investing in narratives, not businesses. He is chasing fleeting trends instead of investing in inevitable needs. His portfolio is not a compounding machine, it's a wealth destruction machine. The path of the trend chaser is stressful, expensive, and almost mathematically guaranteed to lead to underperformance, if not total ruin. The direct financial connection of investing in the inevitables is seen in two beautiful numbers on a financial report: low volatility and dividend stability. Companies that provide essential goods and services tend to have far more stable and predictable revenue streams. Even in a deep recession, people still buy toothpaste, toilet paper, and insurance. They may trade down to a cheaper brand, but the overall demand is remarkably consistent. This business stability translates directly into stock price stability. These boring stocks tend to have a lower beta, meaning they fluctuate less wildly than the overall market. This reduces the stress of investing and helps prevent the investor from panic selling at the worst possible time. Furthermore, because these companies are mature cash producers that don't need to reinvest every penny into speculative growth, they are often reliable and growing dividend payers. For an investor seeking financial freedom, a steadily increasing stream of dividend income from a portfolio of inevitable businesses is the golden path. Each dividend check is a tangible return on your investment, cash in your pocket that can be used to pay your bills or be reinvested to buy more shares, creating a virtuous cycle of compounding. The portfolio of a trend chaser is a series of lottery tickets. The portfolio of an inevitables investor is a collection of money-printing machines. This is the difference between amateur speculation and professional wealth management. We have now arrived at the fifth and final pillar. It is the crucial action step that ties everything together. We have learned to look for simple businesses within our circle of competence that are protected by a durable moat, that function like cash-generating toll booths, and are built on timeless human needs. But even the most perfect business in the world can be a terrible investment if you pay too much for it. The final pillar is the price of simplicity, patience, discipline, and buying predictability at a discount. The one-foot hurdle principle is incomplete without the discipline to wait for the right moment to step over it. The final act of genius is buying these wonderfully boring businesses when the market, in a fit of panic or pessimism, temporarily offers them up at a foolishly low price. The defining anecdote for this principle is the story of Warren Buffett's investment in American Express during the salad oil scandal of 1963. American Express was, at its core, a simple, brilliant toll booth business. It had a dominant position in travelers' checks and a burgeoning credit card business, both of which were protected by powerful brand and network effect moats. It was a business Buffett could understand. Then, disaster struck. A company called Allied Crude Vegetable Oil, a major customer of a warehousing subsidiary of American Express, went bankrupt. It turned out that the massive tanks of salad oil that Allied had used as collateral for loans were mostly filled with seawater. It was a massive fraud, and American Express was on the hook for potentially catastrophic losses. Wall Street panicked. The narrative turned toxic. Pundits predicted that the scandal would bankrupt American Express. The stock price was cut in half in a matter of months. This was a moment of intense, widespread fear. But Buffett, instead of panicking with the herd, saw a potential opportunity. He knew the market was focused on the headline scandal, but he wanted to know if the core businesses, the travelers' checks and credit cards, were being affected. So he did the work. He didn't just read analyst reports. He conducted his own scuttlebutt research. He went to restaurants and travel agencies. He talked to merchants and bankers. He asked them if their customers were still using American Express cards and travelers' checks. The answer he got back was a resounding yes. Consumers and merchants didn't care about a salad oil problem in a warehouse in New Jersey. They cared about the convenience and prestige of the American Express brand. The core business, the real source of value, was completely unharmed. The market was irrationally punishing the entire company for a problem in one small division. Buffett realized he could buy a wonderful, predictable, moat-protected business at a price that implied it was on the verge of collapse. He loaded up, investing 40% of his investment partnership's capital into American Express stock. It was the single largest investment he had ever made. As the panic subsided and the company's true resilient earnings power became clear again, the stock price soared. Buffett made a fortune for his partners. He didn't predict the future. He simply analyzed the present more rationally than everyone else and had the courage to act when price became detached from value. He was, in his own words, greedy when others were fearful. The psychological biases that create these opportunities are loss aversion and herd mentality. Loss aversion is the well-documented phenomenon that for humans, the psychological pain of a loss is about twice as powerful as the pleasure of an equivalent gain. When a stock starts to fall, loss aversion kicks in with a vengeance. We feel an intense pressure to sell to stop the bleeding, to make the pain go away. Herd mentality is our innate instinct to follow the actions of a larger group. When everyone around us is selling, our brain tells us that must be the safe, correct thing to do. When bad news hits a great company, these two biases combine to create a vortex of irrational selling. Loss aversion makes current shareholders sell indiscriminately to avoid more pain. Herd mentality causes others to join in, because everyone else is selling. This collective panic is what pushes the stock price far below the company's long-term intrinsic value. The rational investor, the one who has mastered their emotions, recognizes this dynamic not as a threat, but as the moment of maximum opportunity. Buffett's entire career is built on his ability to remain objective and analytical, while the rest of the market is screaming in fear. He waits patiently for the herd to offer him a wonderful, simple business at a ridiculously cheap price. This discipline is the final and perhaps most difficult piece of the puzzle. The applied mental model for this pillar is the margin of safety framework. This concept, first taught to Buffett by his mentor Benjamin Graham, is the intellectual cornerstone of value investing. It's a two-step process for turning market fear into personal profit. Step 1. Calculate the intrinsic value. For a simple, predictable business that you have already identified using the principles of our first 4 pillars, you must calculate what you believe it is truly worth. You can use a variety of methods, but a discounted cash flow analysis based on your owner earnings projections is a great place to start. The goal is not to get a perfect number down to the penny, but to establish a conservative, reasonable estimate of the business's underlying value. Let's say you analyze a wonderful, boring company and determine its intrinsic value is $100 per share. Step 2. Demand a discount. This is the crucial part. You do not buy the stock when it is trading at or near your calculated intrinsic value. You wait. You wait patiently for the market to give you a big discount. You demand a margin of safety. This margin is the gap between the intrinsic value and the price you are willing to pay. For example, you might decide you will only buy this $100 per share business if the stock price falls to $60. That $40 difference is your margin of safety. It is your protection against bad luck, errors in your judgment, or unforeseen negative events. Buying at a significant discount provides a cushion. If you are wrong about the future growth rate, you can still make a decent return. If the company hits a rough patch, you are less likely to lose money. And if you are right, your returns will be spectacular. The discipline to calculate value and then wait, sometimes for years, for the price to come to you is what separates successful investors from the rest. To truly understand this, we must look at the antithesis, the growth at any price investor. This investor correctly identifies a wonderful company, but is so eager to own it that they ignore valuation completely. This is a common and costly mistake. Let's imagine an investor in the year 2000 who correctly identifies that Coca-Cola is a fantastic, simple, moat-protected business. They are absolutely right about the quality of the company. But this is at the peak of the dot-com bubble, and even old economy stocks have been bid up to extreme valuations. Coca-Cola is trading at nearly 50 times its earnings. Our investor, ignoring the price, buys the stock. What happens? Over the next decade, Coca-Cola the business performs admirably. It continues to grow its earnings and dividends. It's a great company. But the investment performs terribly. It takes more than 10 years for the stock price just to get back to the level where our investor bought it. Why? Because he paid too high a price. The initial valuation was so extreme that all of the company's excellent business performance over the next decade went to just normalizing the valuation, not to generating a return for the shareholder. This is a critical lesson. Even the best business in the world can be a poor investment if you overpay. The what, the quality of the business, and the when, the price you pay, are two separate but equally important decisions. Ignoring the price is just as foolish as buying a bad business. The direct financial connection and the ultimate reward for this disciplined patience is a phenomenon known as multiple expansion, which is a key driver of total shareholder return, TSR. When you successfully buy a great business at a cheap price, your investment returns come from three powerful sources. First, you get the return from the business's own organic growth. As the company sells more products and increases its owner earnings, the intrinsic value of your share of the business grows. Second, you often receive dividends, which provide a direct cash return on your investment. But the third, and often most explosive source of return, is multiple expansion. Let's go back to our margin of safety example. You bought a company with an intrinsic value of $100 when it was trading at $60. Let's say it was earning $6 per share, so you bought it at a price-to-earnings PE multiple of 10. The market was pessimistic. Over the next few years, the temporary problem that caused the fear subsides. The company continues to perform well, the market recognizes its mistake and reevaluates the stock. Other investors are now willing to pay a more reasonable multiple for those earnings, say a PE of 15. The stock price rises not just because earnings have grown, but because the multiple the market is willing to pay for those earnings has expanded from 10 to 15. This is the financial reward for your contrarian bet. This triple threat return from business growth, dividends, and multiple expansion is how true long-term wealth is generated. It is the end game of the one-foot hurdle philosophy. It is how you systematically and reliably beat the S&P 500 over time, building a portfolio that delivers not just growth, but peace of mind. And so, we stand at the end of this deep exploration. We have taken the simple, almost quaint idea of a one-foot hurdle and seen how it blossoms into a comprehensive and powerful system for viewing the world of investing. You now possess the mental framework to build a portfolio that is not just profitable, but resilient. You have acquired a lens that allows you to cut through the deafening noise of the market and focus on what truly matters: simple, predictable businesses, protected by moats that gush cash and can be bought at a discount. You now understand how to distinguish a financial toll booth from a lottery ticket, how to value timeless human needs over fleeting trends, and how to use the market's manic emotions as your greatest source of opportunity. This is not just theory. This is a blueprint for a lifetime of successful investing, a pathway to true financial independence. But our journey is not complete. Understanding this system is a monumental first step, but it is just one crucial piece of a much larger, interconnected puzzle. What we have built today is the engine, the powerful, reliable method for identifying the right kind of companies. But an engine, no matter how powerful, is useless without a steering wheel and a timing belt. You know what timbre to look for. But the mastery of when to act, of how to precisely quantify the market's fear and turn it into a specific purchase order at a specific price, requires a different set of tools. You've learned how to identify the world's most predictable business, but how do you know, with mathematical confidence, the exact moment that predictable business goes on sale? The video that YouTube is showing you on the screen right now is not an accident. It is the missing link. It is the next piece of the map. It takes the what we have established today, the simple, predictable business, and bolts on the critical when. It's the bridge between identifying a great company and buying it at a price that makes you rich. The average person, the speculator, will click away now, satisfied with this one piece of the puzzle, and will likely never put it into action. But you are not the average person. You have invested this time because you are not just collecting information. You are building a complete mental arsenal for your financial future. The choice before you is simple. You can remain an informed spectator, armed with a powerful engine but no way to steer it. Or you can click on that video and install the guidance system. The decision is not about watching another video. It is about whether you are truly committed to completing the machine. Continue your ascent.